Welcome to Griffonomics.
Glad to be diving into this one.
Today, we're looking at a massive stack of source material.
Yeah, quite a bit to get through.
We've got SEC filings, the latest 10K, several press releases, and some really heavily detailed financial analyses.
Right, all centered on one incredibly fascinating company, QXO, Inc.
Exactly. And for you, the listener, the mission for this deep dive is to generate a granular investigative report. We are exploring a fundamental corporate transformation here.
A total metamorphosis, really.
Yeah, we're talking about a company that essentially morphed overnight, going from a small technology firm into a dominant tech-enabled distributor.
And not just in any space, in the massive $800 billion building products industry.
Which is huge. So I want you to look at this as a masterclass in aggressive corporate strategy.
Definitely.
This is a real-time case study in how a company identifies a deeply analog industry and stages a digital takeover at lightning speed. Okay, let's unpack this.
To truly grasp the magnitude of what QXO is attempting here, we have to start with the architects behind the curtain.
Right, the founder.
Yeah, analysts across these financial reports keep referring to something called the Brad Jacobs playbook. He's the founder of QXO, and he has this highly documented track record of executing what the finance world calls multi-billion-dollar roll-ups.
Hold on. For those of us who don't spend our weekends reading private equity textbooks, what does a corporate roll-up actually look like in practice?
So think of a roll-up like playing Monopoly.
Okay.
But instead of buying properties, you're buying up hundreds of small independent businesses in the exact same industry.
I see.
You bring them all under one giant corporate umbrella, slap a single logo on them, and strip out all the duplicate costs.
Like having one unified HR department instead of, 300 separate ones.
Exactly. And he executed this exact playbook previously with XPO Logistics.
That was in the trucking and freight sector, right?
Yeah, right. And before that, with United Rentals in the construction equipment space, he finds a massive, highly fragmented industry, buys up the major players, forces them to integrate, and then
deploys the tech.
Yes. He deploys cutting-edge technology to drive massive efficiencies and boost cash flow.
And the goal he has set for QXO is nothing short of staggering. Looking at their forward projections, they are targeting $50 billion in annual revenue.
Which is wild.
Within the next decade. $50 billion. To put that in perspective, they are trying to conquer an industry that most people never even think about until their roof starts leaking.
Well, the building products distribution industry is an $800 billion global market.
Right.
Split roughly evenly between North America and Western Europe. But the defining characteristic of this market is how scattered it is.
Fragmented.
Highly fragmented.
Yeah.
In North America alone, you have over 7,000 different distributors.
7,000. So we're largely talking about older, privately owned, local or regional mom-and-pop shops.
Exactly. A consolidator like QXO looks at that landscape and just sees pure opportunity.
It's ripe for the picking.
But the fragmentation is really only half the appeal. The other half is the incredibly resilient demand floor.
Yeah, the sources break this demand down in a way that goes against common sense. You'd normally think building products are tied entirely to new home construction.
Which can be incredibly cyclical.
Right, depending on what the Federal Reserve is doing with interest rates.
But if we isolate roofing, which is QXO's foundational market right now, the data tells a completely different story.
How so?
Roughly 80% of roofing distribution revenue is tied directly to repair and remodel spend, R&R.
Okay.
And within that R&R bucket, an astonishing 94% of the spending is considered non-discretionary.
Meaning, if a hurricane blows half the shingles off your house, you don't sit around waiting for mortgage rates to drop before you call a contractor.
Right, you fix it immediately. The structural drivers of that demand are ironclad. We are dealing with aging infrastructure.
Because the average single-family home in the U.S. is over 40 years old.
Exactly. Combine that with the frequency of severe weather events, which has quadrupled over the last 20 years.
Wow, quadrupled.
Yeah, so you have a highly reliable baseline of nonstop demand. Then factor in the remaining 20% of the industry revenue tied to new construction.
Which has its own massive tailwinds.
It does. That sector is currently supported by a massive domestic housing shortage an estimated 4 million units.
And at current build rates, that represents an 8-year backlog.
Okay.
So the market is huge, it's fragmented, and the demand is practically baked into the cake.
It really is.
Here's where it gets really interesting. Because the speed at which QXO moved to capture this market is just breathtaking.
They didn't waste any time.
No, they didn't start by picking off one small lumberyard at a time. What was the first major domino to fall?
The foundational move happened in April 2025. QXO stepped up and acquired Beacon Roofing Supply.
For a staggering $10.6 billion.
$10.6 billion. With that one signature, QXO absorbed roughly 600 branches across the country,
Instantly making them the largest publicly traded roofing distributor in North America.
They went from a microcap tech firm to an absolute behemoth overnight.
And they clearly didn't stop to catch their breath. Less than a year later, the expansion move hit the wire.
February 2026.
Right. They entered into an agreement to acquire Kodiak Building Partners for $2.25 billion in dollars. I want to look at the strategic value of this second move. With Beacon, they conquered roofing. What does Kodiak give them?
The Kodiak deal fundamentally rewrites their horizon. They added lumber, roof trusses, windows, doors, structural construction supplies.
So a whole new catalog.
Exactly. In financial terms, this successfully tripled their TAM, their total addressable market.
Did over $200 billion. Just to clarify TAM for you listening, that basically means if QXO theoretically held a 100% monopoly
Right.
and captured every single dollar spent on those specific products in the market, the pie would be worth $200 billion.
That is the exact way to look at it. Furthermore, Kodiak provides a massive geographic advantage.
Where are they located?
They have a huge footprint in the fast-growing Sunbelt and mountain states. Roughly 40% of Kodiak's 2025 revenues were generated in just 2 states.
Texas and Florida.
Yes, regions where building growth has consistently outpaced the national average over the last decade.
And adding this catalog also allows QXO to cross-sell to large home builders, doesn't it?
It's a huge synergy. Instead of a developer calling one guy for lumber and another guy for shingles, QXO becomes a single-source supplier.
For the entire life cycle of a master plan community.
Precisely.
Okay, so they have the scale and they have the geography. Let's look at the financial realities of building an empire this fast.
The numbers are fascinating.
Because our deep dive into their fiscal year 2025 review shows a revenue explosion that is almost hard to comprehend.
Because the Beacon merger closed early in the year.
Right, so QXO's net sales jumped from a mere $56.9 million in 2024 to an incredible $6.84 billion in 2025.
Massive jump.
But wait, as I'm looking at the headline GAAP numbers here, they posted a net loss of $279.4 million for the year.
Yeah, the headline looks bad.
That sounds like a disaster on paper. Is the core business actually losing hundreds of millions of dollars?
What's fascinating here is how the bottom line looks on paper versus what is actually happening in the cash-generating core of the business.
Okay, break that down.
When you buy a $10 billion company, the accounting gets very messy very quickly. That $279 million GAAP loss was overwhelmingly driven by one-time and non-cash costs.
Associated with the Beacon acquisition.
Exactly.
Walk us through the mechanics of that. Where did the money go?
We are looking at $314.7 million in amortization.
Which is basically an accounting method of slowly expensing the cost of intangible assets over time.
Right. Then you have $83.7 million in direct transaction costs. Bankers, lawyers, that sort of thing.
Right.
But the biggest chunk of noise is a massive $131.7 million in inventory fair value adjustments.
Let me see if I have this right. When QXO bought Beacon, they also bought warehouses full of existing roofing tiles.
Yes.
And the accounting rules require QXO to write up the value of those existing tiles to whatever the current fair market value is.
Correct.
So when QXO eventually sells those tiles to a roofer, the profit margin recognized on their tax forms looks artificially tiny, even though the actual cash coming in the door is completely fine.
That is a perfect summary. When you strip all that accounting noise away, the true health of the business is incredibly strong.
What metric should we be looking at then?
If we look at the adjusted EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Yes, which gives us a much cleaner look at the day-to-day operational cash flow. QXO generated $647.8 million in 2025.
Which represents a 9.5% margin.
Very healthy for this industry.
And what does that look like moving forward into 2026 now that Kodiak is in the mix?
The run rate is where the sheer scale becomes apparent.
Because the run rate takes the current financial performance and projects it out over a full 12-month calendar.
Exactly. With the addition of Kodiak's $2.4 billion in annual revenue, QXO is already pushing toward a $1 billion EBITDA run rate.
Wow.
And they achieved that scale in under 10 months of operations.
So they bought all this revenue, but buying a bunch of old school roofing and lumber companies doesn't suddenly make you a tech company.
True.
Let's transition to the tech-forward disruption piece of this puzzle. How does an operation moving 2x4s and asphalt shingles operate like a Silicon Valley tech disruptor?
It comes down to artificial intelligence and predictive analytics.
AI in a lumberyard.
Yes. QXO views this massive fragmented industry of older, private companies as low-hanging fruit for AI disruption.
Because the incumbents aren't using this stuff.
Not at all. QXO is actively deploying AI to manage inventory at a level of granularity that legacy distributors just cannot match. They are utilizing predictive analytics for SKU-level inventory forecasting.
I have to interject here because I can't even keep track of the 3 different types of screws I have rolling around in my garage.
Right.
And they are using AI to track over 135,000 different SKUs.
Stock-keeping units, yes.
Across hundreds of branches in the Sun Belt.
The computing power required to do that effectively is staggering. Knowing exactly what specific product needs to be at what specific branch at what exact time.
It minimizes the amount of inventory just sitting on shelves collecting dust.
Which directly maximizes cash flow. They are also utilizing AI-led data analysis to understand pricing elasticity across that massive catalog.
Meaning their systems can dynamically optimize pricing strategies.
Exactly. If a storm is forecasted in Florida, the AI understands the historical spike in demand for plywood and tarps.
So it adjusts pricing ahead of time.
Yeah. Yes. To capture the highest possible margins without losing the sale to a competitor.
And the sources detail how this extends to the physical supply chain, too. They're bringing in high-level logistics expertise to standardize warehouse shipping and handling processes across all these newly acquired branches.
Standardizing the physical movement of goods.
Yeah. They are running cutting-edge route optimization software to maximize their fleet utilization. They aren't just selling the materials, they are ensuring the last-mile delivery to the job site uses the absolute minimum amount of gas and driver time possible.
It's all about efficiency.
I want you, the listener, to just imagine the sheer competitive advantage of bringing that level of data analytics and logistics software to a local, independent lumberyard. It's a completely unfair fight.
It is. The scale and the technology create what we call a virtuous cycle. It forms a formidable competitive moat.
How so?
Think about it. A local mom-and-pop distributor simply does not have the millions of dollars required to build custom AI software.
Nor do they have the massive data sets required to train it?
Exactly. Larger distributors like QXO have the purchasing power to negotiate better terms with suppliers, and they have the capital to invest in differentiating tech.
That tech drives better margins.
Which gives them more capital.
Which allows them to buy out more competitors. It just feeds itself.
It does.
Which brings us to the elephant in the room. Capital.
The fuel for the fire.
How exactly is QXO affording this aggressive multi-billion-dollar buying spree?
Right.
When we look at the balance sheet, the liquidity is definitely there.
They ended 2025 with $2.36 billion in cash.
But they also carry a massive debt load. $3.1 billion in long-term debt.
Which is primarily made up of senior secured notes and a term loan used to fund the Beacon deal.
Right. And for the layperson, a senior secured note basically means a loan backed by hard assets. If QXO defaults, the bank gets to seize the warehouses, the trucks, the inventory.
They are undeniably highly leveraged, but they're also utilizing the equity markets incredibly aggressively to balance that out.
The Apollo deal.
Yes. The most critical piece of their capital allocation strategy is the massive war chest they secured in January 2026.
QXO announced a $3 billion convertible preferred equity commitment led by Apollo Global Management.
With participation from Temasek and a few others.
$3 billion is a staggering amount of dry powder. But a convertible preferred equity commitment sounds like a phrase designed to put people to sleep.
It's quite technical, yes.
Break down the actual mechanics of a deal like that. What does Apollo get out of handing over $3 billion?
It acts like a hybrid between a loan and stock ownership. It's structured as a Series C perpetual preferred stock.
Meaning?
This means it pays a very safe, guaranteed preferred dividend rate of 4.75% 5% per year to Apollo.
Okay, it's a decent yield.
But the convertible part is the kicker. The investors have the right to magically turn that preferred stock into regular shares of QXO common stock.
At what price?
An initial conversion price of $23.25 per share.
So they get a guaranteed yield while they wait, but if QXO's stock shoots the moon, Apollo can convert and ride the rocket ship up.
If we connect this to the bigger picture, the true significance of this $3 billion Apollo deal is what the money is legally earmarked for.
It's restricted.
Yes. According to the investment agreement, these funds are exclusively designated to fund future qualifying acquisitions.
And a qualifying acquisition is explicitly defined as a deal with a purchase price exceeding $1.5 billion.
Correct. And the commitment window to use this money runs out in July 2026.
Wow, so this isn't money to keep the lights on or pay down that existing debt or hire more software engineers. This is a targeted strike fund. It means QXO is actively, right now, hunting for its next massive target.
And they have a ticking clock to deploy that capital before the summer of 2026.
So what does this all mean? We've talked about the incredible growth, the AI disruption, the massive war chest, but in any deep dive, we have to flip the coin and look at the structural vulnerabilities.
The bear case.
Exactly, we need the bear case. Where does this grand vision potentially fall apart?
The primary financial risk, specifically to the everyday retail investor holding standard stock, is the sheer scale of the dilution wall.
Because QXO has aggressively used the equity markets to print shares to fund this rapid expansion.
To give you an idea of the math, the total outstanding shares at QXO jumped from roughly 409 million at the end of 2024.
To over 674 million by the end of 2025.
Yes.
That is a massive expansion of the share pool. If you are baking a pie and suddenly cut it into 674 slices instead of 409, everyone's individual slice gets significantly smaller.
And the slicing isn't finished. There are nearly 500 million additional potential shares currently lurking in the background.
500 million.
Yes. These are tied up in outstanding warrants, which are essentially corporate coupons allowing the holder to buy stock later at a set price.
And convertibles, like that $3 billion Apollo deal we just discussed.
Exactly. If and when those instruments convert to common stock, the existing shareholders' ownership gets diluted even further.
Then there are the governance risks, which, to their credit, the SEC filings lay out very clearly in the risk factors section.
QXO is not a typical public company in terms of shareholder influence.
Founder Brad Jacobs personally controls 22.1% of the total voting power of the company.
It's substantial.
On top of that, his personal investment entity, Jacobs Private Equity, or JPE, has the contractual right to designate 40% of the board of directors.
That level of concentrated control is a major vulnerability for a regular investor. It allows Brad Jacobs to exert outsized influence over major corporate decisions,
regardless of what the other stockholders might want.
Practically speaking, this structure could easily deter, delay, or entirely prevent a hostile takeover.
Meaning, if a behemoth like Amazon or Home Depot suddenly decided they wanted to buy QXO at double the current stock price,
Brad Jacobs could essentially block the deal from happening,
potentially depriving regular stockholders of a massive, lucrative acquisition premium.
The paperwork gives him the power to do exactly that. And beyond the financial and governance structures, we have to look at the sheer operational high-wire act the company is currently performing.
They're attempting to integrate massive, complex legacy cultures.
Harmonizing the IT systems, the supply chains, the thousands of employees from Beacon and Kodiak without causing major operational disruptions.
It's an incredibly delicate, prolonged task. And they are performing this operational high-wire act while carrying that $3.1 billion debt load we mentioned earlier.
That debt requires substantial cash flow just to service the interest payments, and it comes with strict covenants from the banks.
These covenants are basically rules that limit QXO's flexibility to incur more debt, pay dividends, or maneuver quickly during an economic downturn.
Exactly. If the integration of these acquired companies hits a speed bump, or if the projected AI synergies fail to materialize as quickly as promised,
that $3.1 billion debt load becomes a very heavy anchor holding the entire operation down.
It does.
That brings us to our final verdict on the strategic outlook for QXO. Based on the mountain of sources we've gone through today, we are officially rating this corporate transformation as high risk, high reward.
The upside is anchored by a historically proven management team executing a validated playbook.
backed by billions in elite Wall Street capital. If they hit that $50 billion target, the value creation will be something business schools study for decades.
But ultimate success depends entirely on flawless execution. They have to successfully merge these massive legacy cultures.
And they have to seamlessly deploy highly sophisticated AI into old-school distribution models.
Models that have quite frankly operated the same way since the 1980s.
Right.
This raises an important question. How will macroeconomic cyclicality test this newly built empire before those tech synergies are fully realized?
Because while the repair and remodel market is resilient, QXO is still highly exposed to fluctuating interest rates, inflation spikes, housing inventory levels, and severe weather patterns.
Things that can unexpectedly halt construction.
They are racing against the clock to build their tech-enabled moat before a potential economic downturn stress tests their highly leveraged balance sheet.
It is a foot race between internal integration and the broader economy.
It is. And to leave you with a final provocative thought to mull over, something drawn directly from the fine print of the risk factors QXO explicitly warned about in their own 10-K filing.
The cyber aspect.
Yes, consider the cybersecurity implications of this roll-up. Historically, the building products distribution industry was made up of thousands of small, disconnected mom-and-pop shops.
From a hacker's perspective, the industry was simply too fragmented to be attacked at scale.
Right, hacking one local lumber yard in Ohio didn't get you very far. But by aggressively forcing AI, cloud computing, and digital transformation onto newly acquired legacy businesses that historically had far less sophisticated IT.
Is QXO inadvertently creating a massive, centralized, highly vulnerable target?
Exactly. They're building a sprawling digital empire, but in doing so, they might just be painting the biggest cybersecurity bullseye this industry has ever seen. Risk defined, portfolio protected.